I'm Megan Horniman, the Chief Investment Officer for Verdant's Capital Advisors. We're 3 weeks now into the most recent banking crisis, and while we've seen a lot of that frenzy behavior soften here as of late, we wanted to step back and really explain why the most recent banking turmoil has occurred. We want to reassure investors that this is not 2008 and 2009. Then we're going to talk about what it means for the economy, and most specifically what it means for portfolio allocation. Let's unpack the events that have led up to the most recent banking turmoil. What do banks love? They love receiving money. That's in the form of deposits. They pay a small level of interest rates in order for you to deposit your money at their bank. Now, what happens when the Federal Reserve raises interest rates as aggressively as they have over the past year? You start to see other investments, short-term safe investments, that are paying a significant amount more on an interest rate level than bank deposits. So we've seen, not only in small and mid-cap banks, but also in large-cap banks, a dwindling of the deposit base. That's detrimental to a bank when they start losing deposits. Now, what we've seen over the past 3 weeks is the Fed raising interest rates has also exposed weakness in some of the assets on those bank balance sheets. So some of the small and mid-cap, very niche banks invested in things like cryptocurrencies or venture capital or small startup technology, all of these things that thrived in a low interest rate environment. Lastly, they did the right thing by also holding on their balance sheet treasuries, the safest of investments out there. But they were long-term treasuries, meaning that as the Fed was raising interest rates, the value of those bonds went down. So you have a weakness in the balance sheet. You have depositors that are now worried about the bank that's holding their money. They want their money out. And in this day and age, you can move money very quickly. And the banks could not keep up with selling assets in order to satisfy those withdrawals. What happens is a generic, old-fashioned run on the bank, and that's what we've seen over the past 3 weeks. We believe that the most recent turmoil is not 2008 and 2009, but we also sympathize with the many media headlines about the most recent turmoil that the fear investors can feel is very similar. There's many reasons and differences between what's going on right now in 2008 and 2009. First of all, keep in mind that in the aftermath of 2008 and 2009, the regulation shored up the balance sheet of many of the banks in the U.S. When you look at this chart, this is what we call a Tier 1 capital ratio. It is simply the assets on banks' balance sheets compared to their risk-weighted assets. It's significantly stronger than what we saw leading up to the great financial crisis. Also, this is not the situation where we have over-leverage. We have a system where we can't value investments. We have significant counterparty risk. Instead, what's happened in the most recent scenario is a mismanagement, not only of some of the assets that they've held, but a mismanagement from a risk perspective on interest rate risk. So what does all this mean for the outlook for economic growth? And most specifically, does it change anything from an asset allocation perspective? As far as economic growth coming into this year, we warned about our less than optimistic outlook for the economy. We've seen that the Fed's tightening policy has started to filter into the economy with the consumer, with manufacturing, with the housing market. That was going to weigh on growth this year. But now we're adding another layer of complexity with the banking system. And when you tend to see crises or turmoil like this, you do see banks pull back on lending. So there's less stimulative action into the economy. That should weigh on growth this year. What does that mean as far as our asset allocation? Well, we came into this year building some dry powder in our accounts because we were concerned about the economic outlook for the year. We think it would probably be wise in order to raise a little bit more cash in the accounts and have that dry powder or that extra liquidity to take advantage of opportunities as they arise this year. And we think that they will. We think that from a long-term perspective, we still do like the global equity markets, but there's going to to be some opportunities that will arise in traditional fixed income that we haven't been able to take advantage of. So we will continue to monitor the situation, what it means for growth, what it means for our portfolios, and specifically make sure that we take into consideration everybody's risk tolerance as well. There's really 3 takeaways from this conversation. First of all, expect more banking regulation and expect more consolidation, specifically in the small and mid-cap space. Second, unfortunately, the U.S. economy is most likely going to enter a recession in 2023. But remember, for the long run, recessions are not always a bad thing. They do clear out excesses in the economy, and that is needed for us to have long-term stability from an economic growth perspective. Lastly, opportunity. We think that over the coming months and throughout 2023, there's going to be a lot of opportunities to put that cash and dry powder to work because there will be market dislocations as people are trying to assess the damage that's going to be caused to the economy because of the most recent events and also the Fed's tightening cycle. We'll continue to look at portfolios, we'll monitor asset allocation, and we'll take advantage of those dislocations in the market if it makes sense from a long-term perspective. Now, if you have any questions at all, please feel free to reach out to your financial advisor.